Hello and welcome. This is Professor Svark, and in this video I'm going to take you through selected topics in Chapter 1. I want to remind you that these ACC sessions cover selected topics only, so you do need to read and take notes from all the material in this chapter. If you have any questions at all, I recommend going right to the tutoring center or seeking help from me. It's especially important in chapters 1, 2, and 3 that you understand all of the material because this is the building blocks for the rest of the course. I also, for that reason, recommend that you complete all the coursework in this chapter, and also, as a part of the course, to complete all those points. I also recommend that you create flashcards or some other form of study aid in order to self-quiz, because really learning comes from recall, not simply just looking at the material or repeating the material, but it's that active self-quizzing or recall. In this chapter, or in this video, we're going to cover 3 crucial pieces of this course: the accounting equation, accounting transactions, and financial statements. We're going to start with the accounting equation. Assets equal liabilities plus owner's equity. And you can see that I have owners in parentheses. The reason that I have it in parentheses is because it differs from your textbook. If you look at your textbook, they explain it as stockholders' equity. The reason that I use owners is because it makes a nice acronym. Assets equal liabilities plus owner's equity, or ALO. Now, stockholders' equity is essentially the same thing. It just means that it's a corporation, so stockholders own the company. But if you think of it in terms just to help you remember the equation and know that owners are stockholders, it's a very helpful study aid. Now, this is the accounting equation, but owner's equity has 4 pieces. So under owner's equity, we have common stock, revenues, expenses, and dividends. I also have an acronym for owner's equity, and that's C-RED, because accountants never want to see red. So there's a little accounting humor to impress your friends. Alright, so common stock and revenues both increase owner's equity. Expenses and dividends, you can see, both decrease owner's equity. So if you want a help aid or study aid to remember this, you can think of it as ED. What decreases owner's equity? ED does. Alright, so let's define each of the pieces of this equation. What is an asset? An asset is something that's owned or controlled by a company. So just like you as an individual own lots of things, or maybe aspire to own many things, things like vehicles, maybe a house, cash, maybe a computer, companies can own those same types of items. Here are some examples of commonly owned assets: cash, supplies, equipment, vehicles, land, building, and accounts receivable. So a couple of these I want to touch on. Supplies, for example. You, at the beginning of the semester, may have gone out and purchased some supplies for class. Typically, we would think of those as just ordinary expenses or costs. But in a company, the companies typically buy supplies, whether they're cleaning supplies, office supplies, or other types of supplies. They buy those in bulk. So therefore, they're assets, items that are owned by the company, and they're purchased in bulk and sitting there waiting and ready for use. They're an asset. Once they are used, once we take that bottle of Windex or that pen out of the cabinet and start using it, then we can record it as a cost of the company and expense. But an asset is something that's owned or controlled by the company. Another item I want to touch on is accounts receivable. When a company does business, maybe they provide a service to a customer, and the customer does not pay them right away. They want to go ahead and record that that customer owes them money. So accounts receivable is the record that indicates that that customer owes them money. Accounts receivable is controlled by the company. It's a balance that is owned and controlled by the company. If the company decides to reduce that amount or change that amount or charge interest on that amount, it has that control. So accounts receivable should feel kind of new, and supplies might feel kind of awkward for a little bit. When we think about supplies, you have to think bulk and picture that big supply cabinet full of unused supplies. Equipment, vehicles, land, and buildings are sometimes referred to as fixed assets. They're items, or large-scale items, that are owned by the company, and they're assets. So all of these items here to the left are owned by the company and they provide value to the company. On the other side of this equal sign, you have liabilities. They're kind of the opposite. You can think of it as almost a mirror. A liability is something that's owed by the company. So if we in turn owe one of our vendors, that's typically recorded into an account called accounts payable, which indicates that we owe this money to our vendor. Same thing for wages payable. If a company comes in and works, if an employee comes in and works for the day, we're not paying them cash at the end of every day or cutting a check at the end of every day, but rather we owe them at the end of each day part of their paycheck. So that can be tracked in an account called wages payable. And then a third example I have here is notes payable. Notes payable and accounts payable are very similar, but for accounts payable, that's more of an honor system. Accounts payable is, hey, you delivered some goods to me or some supplies and I owe you. I'm not officially signing an agreement. It's, not formal, but I owe you the money. Whereas notes payable is a very formal document. I go to the bank and sign a notes payable. So often with a beginning accounting class, you can think of the difference between accounts payable and notes payable as simple as a signature. Notes payable is formal and signed. Often students get accounts receivable and accounts payable confused. What I recommend that you do is anytime there's a transaction that's happening on account, ask yourself, is the company receiving cash in the future or is the company paying cash in the future? And that should help you. It's the future action of the cash. Are we receiving it because of a sale or are we paying it because of something that we purchased? Owner's equity, remember, consists of C red, and there I have Ed circled, meaning Ed is decreasing equity. Now, common stock is just an account that tracks cash or other investments in the company. So basically, I like to think of accounting as really, it's a database. All we're doing is taking different transactions and sorting them into different buckets. So whenever we have a person that invests in our company and we provide common stock in return, somewhere we need to track how much investment we've received, and that's in this common stock bucket. Revenues is an account that tracks fees charged to customers for service or sales. So it doesn't matter whether we receive the cash on the spot or the customer owes us. Anytime we earn revenue, we need to record it in this bucket. Some examples of how that might look for a company: they may call this account consulting revenue, fees earned, rent revenue, or sales. Those are all common revenue accounts. Okay, so if we provide services, and maybe we're an IT consulting company, every time we provide services to a customer, we would go ahead and record that transaction in the consulting revenue account. Same thing, if we were a landscaping company. If we provided landscaping services to a customer, we would record that in a fees earned account. okay, or a landscaping revenue account. So you may see the revenue account called a variety of different things, but these are very common. Consulting revenue, or painting revenue, or consulting fees earned, or painting fees earned. And then later on in Chapter 4 we'll get into sales, and that's another revenue account. Now, expenses track the costs of businesses. So we talked a little bit about supplies earlier. Remember, when the company purchases supplies, you have to think in very large bulk. It's not a cost to the company immediately. Immediately, when we load those supplies, those bulk supplies, off the truck and put them in our supply room or supply desk, wherever it is that we keep our bulk supplies, we record it as an asset. It's unused, it's ready and waiting for us. Once we start using those supplies, now they're costs, okay? And we would record them as an expense. And another way that may help to think of it, those supplies that are sitting unused in a supply room, if we decided we needed money, we could sell those supplies. Now, in all reality, we probably wouldn't do that, but they have value. Once we use them, they're a cost. Okay. Another good example of that might be gasoline. If you bought gasoline and you stored it in a huge bin, right, that's an asset. But once you start using it, it's an expense. It's a cost. We have wage expense. Obviously, those are costs of our employees. Rent expense, again, costs of renting out a storefront or an office building or something along those lines. Supplies expense I just talked about. Advertising expense, utility expense. Okay, all common expense accounts among many others, and we'll cover a lot of different expense accounts. Okay, and finally, dividends. Dividends tracks payments to investors. Maybe you've received a dividend in the past, or you've heard somebody talk about, hey, I got some dividends. If you own stock in a company such as Best Buy and you receive a dividend, it's kind of a reward for investing in them. You didn't earn it. You didn't, there's nothing that you did for it. It's kind of, and the reason I'm explaining it that way is because it's a category all of its own. It's not an expense. It's not, it's not a payable. It's simply a dividend. We provide kind of like a bonus to our investors. So that's dividends. And again, think of this just like a database. We're just taking each transaction and sorting it into these different buckets. So we talked about the difference between supplies as an asset, which would be the warehouse, the unopened, versus supplies as an expense. We've used it, now we're recording it as an expense. Another item that I didn't talk about would be, if you think about an asset, you see the building, land and building. We separate those items out if you own a company versus if we purchase a house on a piece of property. When you and I go out and buy a house or a condo, it's all kind of a purchase together. But in companies, we separate them out, and they're assets. And the difference here, they're not recorded as expenses, but the building will be recorded as an expense, and we'll learn that transaction in Chapter 3. But for now, think of that as an asset. It has value to the company owns and controls it. And we'll later learn how we're going to take a piece of that building and record it as a cost or an expense over time. All right, so you have a worksheet that you could print out, and I just want to go through some simple, a simple example of this accounting equation. The accounting equation always has to stay in balance. So if you have $7,500 in assets and you have $4,000 in equity, both sides have to equal. The left hand has to equal the right hand. So we could solve that and say $7,500 versus $4,000 we must know then that our liabilities equal $3,500 because they have to be in balance. That's a nice check and balance for accountants. As you know, if something is out of whack, if something doesn't balance, then we know we made an error. And B, if our assets are unknown, but we know our liabilities are $2,500 and our equity is $7,000, then we know that our assets must equal $9,500. If they don't, again, there was an error. And in C, if assets equal $8,500 and liabilities equal $2,000, then we just have to solve for the difference, right? Our left hand has to equal our right hand. So equity must equal $6,500. Okay, remember, accounting is not math. It's a new language. And right now what we need to learn is where do we categorize these different costs. All right. So now we're going to go into analyzing business transactions and categorizing these. So here's 9 different transactions, and we're going to go ahead and record those in our accounting equation. Each of these items affects an asset, a liability, or an equity account, or any mix of those items. Each transaction will affect at least 2 accounts. Some may affect 3, but at least 2 accounts. And those could be 2 assets, or an asset and a liability, or an asset and an equity. Okay, so it could be a mix, but each one is going to have at least 2 effects. So the first transaction, and you can see I've got assets equal liabilities plus owner's equity, and under owner's equity we've got C red, common stock, revenues, expenses, and dividends. So number 1, let's invest $2,500 into a delivery business. Now the most common error I have here is students think, okay, now I have $2,500, or the owner just gave up $2,500. From this point on, we are always the accountants for the business. We're only concerned about what is happening to the business money, not to the owner. Because once the owner invests into a company, now it's the company's money. So we don't care that the business owner just reduced cash by $2,500. What we care about is the company itself just received $2,500 of cash. So what's going to happen here is cash is going to go up by $2,500. My left side increased by $2,500. If an owner invests cash or assets into a company, the other side of that is we need to track the investment in the common stock bucket. So common stock is going to go up. Now we have the left side has increased by $2,500 and the right side has increased by $2,500. Number 2, we purchased $10,500 for a delivery van with $500 down and by signing a note for the difference. Okay, so I always recommend ask yourself, what just happened to cash? Well, cash decreased by $500. We know that. Okay. We purchased a delivery van. What is a delivery van? That's an asset to the company. Okay. But we also signed a note for the difference between cash paid and the price of the delivery van. So that's going to be a liability, the money we owe. We owe, and because it was signed, it goes into notes payable. So $10,000. Okay. And what's the difference there? We have a decrease of cash of $500, an increase of notes payable of $10,000. The other piece of that is that our assets, our vehicle, increased by $10,500. So the overall effect of this is our assets, because vehicle is an asset also, our assets increased by $10,000, and our liabilities on the other side increased by $10,000. So now both sides, this line here drawn should be over the equal sign, both sides we have $12,500. Okay, so this affected 3 accounts. Overall, we have to check the left side versus the right side. So it was an increase to assets of $10,000 overall and an increase to liabilities of $10,000. Okay. In 3, let's purchase $75 of supplies on account. Anytime you see the word on account, you want to ask yourself, is that accounts receivable or accounts payable? Well, what's the future of that transaction? Are we going to receive $75 of cash or pay $75 of cash? Well, if we're purchasing supplies on account, it's kind of like going to the mall and buying something on your credit card. We have to pay for it later. So nothing happened to cash in this transaction, but in this transaction we're buying supplies, which again, bulk, unused, it's an asset. The other side of that, okay, so there's your asset. The other side of that is an accounts payable. It's a liability. All right, so now we have number 4. Let's purchase $250 in advertising and pay cash. Okay, what happened to cash here? Cash decreased. Advertising is a cost of doing business, so that's an expense. So here we have a decrease of cash of $250 on the left side and advertising expenses on the right side. Now, advertising expenses is an account that decreases equity. So we could also record this with a negative sign here. But I like to show it as a increase in the balance. It's kind of like if I asked you to track how much did you pay for your lunches every day this week. Okay, the first day if you went out and spent $5, that would be $5. The next day, you know, if you spent $12, well now you're up to $17. Okay, but they're all expenses. They're decreasing the amount of money that you have on hand, right? So here, these expenses will decrease equity. Okay, so what happened to the left side versus the right side? Okay, our left side went down by $250 and our right side overall went down by $250. All right, number 5, we make 2 deliveries and collect $100 cash for each delivery. What happened to cash? We increase cash, so it's a plus to cash for $200. And if we make deliveries, remember we're a delivery company, so that means we earn revenue. So here we have our plus to cash, left side, and plus to delivery fees or delivery revenue on the right side. Okay, we're in balance. And if we add it up, if we did a sum of our cash plus vehicles and supplies, it would add up to all the amounts on the right side. All right, number 6, we make 3 deliveries for $100 and send the customer a bill. Okay, cash did not change in this transaction, but we still get to record the revenue. So we increase revenue in this account, but what's the other side of that? It's on account. Our customer owes us money in the future. We're going to receive cash in the future. So accounts receivable, which is an asset, because remember, we control that balance. So there's your delivery fees and your accounts receivable. Okay, this might feel a little tricky and you just need practice. Okay, I would recommend print out a blank sheet and go over this. Even though you've done it once or you've seen me do it, quiz yourself. Do it over again. Okay, and just keep trying to go over these transactions or turn these transactions into flashcards where you say, you know, cash, asset, increase. Well, in this case, it was accounts receivable. Accounts receivable increase, delivery fees or revenue increase. Okay. And 7, make $50 payment for transaction 3. Okay, remember transaction 3 was buying supplies on account. So here cash, what's happening to cash? Cash goes down. And what else goes down? Well, we're not adding supplies. All we're doing is we're paying down that credit card. So it's the same example. You go to the mall, you buy something on your credit card. Now you have it. Let's say it's a pair of jeans. You bought a $75 pair of jeans. Okay, you walk out of the mall, you have the jeans, and you have a credit card bill. Month end comes along, you pay $50 of that bill, your credit card bill. What happens? Your cash in your wallet decreases, and your credit card balance goes down. accounts payable, you can kind of think about it in those same type of terms. So a lot of students want to go over and do something to supplies. Well, supplies didn't change. This is simply paying down that balance owed. Okay, so decrease the cash, decrease the payable. If you collect $200 from customer in transaction 6, okay, again, cash goes up. And again, if you get stuck, look at what happened to cash, up or down. So cash goes up, but what happens now? It's not extra revenue because you didn't do more work. It's simply recording a decrease in the balance owed from the customer. It's the opposite of that accounts payable transaction. Okay. Now we want to record that, hey, we received $200 of cash, so our customer no longer owes us. Well, they owe us still $100, but they don't owe us the $200. So think of it like a database, and we just want to put everything in the right bucket, and we want to track the balances of everything. And again, I'm going through this rather quickly, but for a while it might take you some thinking. And again, that's why I can't say enough. Just self-quiz and think through these transactions over and over again until you're comfortable with them. All right, pay $50 in dividends. Again, cash first. What happens to cash? Cash is decreased by 50. What's the other side of that? Dividends, remember, is its own unique bucket. So we're going to go over here and record dividends. And again, dividends decreases equity. Okay, so next we're going to go ahead and just total everything. So cash is $2,050. Vehicles doesn't need a total because it didn't change. Supplies is $75. Accounts receivable is $100. Notes payable stays at $10,000. Accounts payable is $25. Means we still owe just a little bit. Common stocks $2,500. Delivery fees $500. Advertising expenses $250. And dividends is $50. And if we added up all these balances, and we added up all the balances on the right, subtracting ed, we should be in balance. So on the left, all of our balances equal $12,725. And on the right, because we're decreasing or subtracting out ed, we get the same balance, $12,725. Okay, so once we analyze and record each transaction, now we're ready to prepare financial statements. Okay, we're going to cover 4 financial statements in this class: the income statement, statement of retained earnings, the balance sheet, and statement of cash flows. Statement of cash flows you're going to read about, and you might even have a couple of questions of homework, but we're not going to cover it on exam 1. So go ahead and just read about it, kind of take it in and push it right back out. The 3 financial statements I want you to learn and basically memorize for exam number 1 is the income statement, statement of retained earnings, and balance sheet. All right, so the income statement. It's very important that you learn the titles of each company, or of each statement, rather. You're going to start with whatever the company's name is on top. You want the report to have a title, the income statement, and you want to show this is for the period ended whatever date. So you want to show this is for the month ended July 31st, the quarter ended September 30th, or the year ended December 31st, or whatever your period may be. But you want to show that time frame, because if a company makes, let's say, $10,000, well, if that's for an entire year, it's going to be different than if it's for 1 month. Okay, so you need to show the user of these financial statements, what is this money that's been earned? Is it for a month, a week, a quarter, a year, whatever it may be? And this is my Cliff Note version. You can notice that it's just real simple because I want you guys to start remembering this. Revenues equal expenses, revenues minus expenses equal net income, or if you lost money, net loss. Okay, so start right away with your titles and your Cliff Notes. Revenues minus expenses equals net income. Okay, when you look at your textbook, in reality you want to list out each different type of expense. But for your Cliff Note version, to get you guys started, I just want you to remember revenues minus expenses equal net income. So Here we've got our revenues and our expenses. Pretty simple, right? Here's our company, Speedy Delivery Company, the income statement. We're going to say this is the month ended July 31st. Fees earned, 500. Let's go back. Remember, it's 500. Expenses, we just had advertising expense. So revenues minus expenses equals net income, $250. Okay, and again, that's not pretty. So if you look in your book, you're going to see very nice financial statements. I'm not worried about you guys going out and preparing perfect financial statements. What I want you to do is kind of get that Cliff Note version. Do you know how it's laid out? And do you know how to categorize each piece? And can you get the right totals? All right, statement of retained earnings. Again, company name, report name, statement of retained earnings, and for the period ended, whatever that may be. It's going to mirror the income statement. For the period or for the month ended, for the quarter ended, for the year ended. You want to show the user of the financial statements, what is this about? Statement of retained earnings is exactly what it sounds like. It's how much of those earnings, those net income, have you retained over time? How much have you kept in the company? There's only two choices. You can keep net income and roll it into the company for the future, or you can pay out dividends. So here, our Cliff Note version is beginning retained earnings plus net income minus dividends equals your ending retained earnings. With a new company, which you're going to have several examples as you start your homework, if you're brand new, starting a brand new company, beginning retained earnings will equal 0. Okay? After the first period, the ending retained earnings rolls into and becomes the next period's beginning retained earnings. All right, so again, what we're looking for is beginning retained earnings, which is a 0. We just started the company. Plus net income. Well, where's that number from? Okay, we just computed it in our income statement. So beginning retained earnings 0 plus net income minus dividends equals ending retained earnings. Okay, here's our statement. Speedy Delivery Company, statement of retained earnings. Remember that the time frames mirror each other. Month ended July 31st. Beginning retained earnings is 0 plus net income comes from the income statement. So these financial statements have to be prepared in that order so that you have net income carries into the statement of retained earnings. We paid out $50 of dividends, so that means that we kept $200 into the company. All right, the final financial statement is the balance sheet. Company name, report name is balance sheet. This is not a time period. This is a specific day. This is the assets and liabilities owned as of this specific day. And this number, assets, for example, cash will change daily. So you just have to take a picture, boom, this is the day. And it will always be the ending date of the period we just analyzed in the income statement and statement of retained earnings. Okay, so this is going to look like ALLO. Here's your assets on the left, liabilities on the right, and owner's equity or stockholders' equity on the right. Okay, assets equal liabilities plus owner's equity. The difference here is that C red is now rolled up into only C, and then the rest of it gets rolled into retained earnings. So we've lost red. Red has become retained earnings. Okay, oops. All right, so here's your asset balances. Here's your liability balances. Where do we get retained earnings? We just computed it. Okay, so remember, here's your liabilities, your common stock. C red becomes C and retained earnings. We just computed retained earnings. So here's your income statement, your statement of retained earnings, Speedy Delivery Company, the balance sheet, month, and ooh, that's an error. This should just be July 31st. Okay, so don't make that error, cross that off. Here's our assets, all listed out. Your liabilities all listed out. Remember, owner's equity becomes just common stock, $2,500, and then retained earnings gets moved from above. Okay, and our final check is, do assets equal liabilities plus stockholders' equity or owner's equity? Okay, in this case they do, so that's a final check. So I recommend, again, some flashcards or cliff notes that you repeat, you write out, okay, or print out this worksheet and do it blank in the morning, okay, and just see how much you retain and keep on doing it till you retain everything. Know your income statement. Revenues minus expenses equals net income. Your statement of retained earnings. Beginning retained earnings plus net income minus dividends equals ending retained earnings. And your balance sheet, which looks like ALO, assets equals liabilities, but now owner's equity becomes just C and retained earnings. Now you might be asking, well, what happened to red? Well, here's what happened to red. Here's your R and E. Revenues and expenses get rolled into net income. D, dividends, is over here. So your net income rolls into statement of retained earnings and dividends comes out of retained earnings. Oops. So your red is in this balance sheet. It's just all rolled up into retained earnings. Okay. All right, so chapter 1, important pieces that you must start memorizing. Okay, and it may feel clunky for a while, but with practice, it's going to get easier. And again, you know, a lot of students want to overanalyze things. If you're struggling, just start with memorizing. It will turn into understanding. So memorize that accounting equation, ALO and C red. Practice the accounting transactions. I gave you 9 very common transactions. Just go through those. If you can, create flashcards. Purchase supplies on account. Increase to supplies, which is an asset. Increase accounts payable, which is a liability. Okay, and then financial statements. Those are your Cliff Note financial statements. Income statement, statement of retained earnings, and balance sheet. In chapter 2, we're going to start looking at debits and credits. We're going to take these same transactions and convert them to debit and credit thinking. Okay, which is a little bit tougher. So get these 9 transactions down. And in chapter 2, we'll cover financial statements again, which will not change. So start working on those financial statements. We're going to come back at you with financial statements in chapter 2 and chapter 3. All right, if you have any questions, don't hesitate to contact me. We'll see you in chapter 2.